So let's just start on this PPI print. How indicative of of CPI is the PPI numbers that we got in this morning?
Yeah, good morning. I don't think it tells an awful lot about the CPI tomorrow, but in terms of the personal consumption expenditure index that we get a little later this month, it is certainly good news that that is slightly lower than expected. But I think for the CPI tomorrow, it's of limited use, but still, I think there is a decent chance that, both growth and inflation are actually continuing to head into the right direction. And I think particularly with regard to the last 2 weeks, certainly better than some had feared just a week or a little over a week ago.
So Max, what does that tell us just about, I guess, the progress that we have made, maybe the volatilities? There certainly is still a lot of uncertainty within the market. We just had the Bank of America's Fund Manager Survey out this morning talking about the fact that, yes, investors are a little bit more confident that we are going to see a soft landing, but many are still pricing in or expecting or would like the Fed to cut 4 times this year. So talk to us just about how that contradicts itself and maybe what that tells us just about some of the uncertainty that is at play right now in the markets.
I don't think it's actually contradicting itself. I think it's actually quite helpful going forward. If we look at the next couple of months, I think the really, really worrying sign would be if you saw all fund managers, all portfolio managers agreeing with each other and saying, yeah, absolutely, it's going to be a soft landing. There's no way that there will be a recession. There's no way that inflation is going to pick up again. There's no way that there's other risks on the horizon. Everything is rock and roll. I think that would be a concerning sign. So, in fact, I think the fact that you still have a lot of people still worried about some sort of tail risks, perhaps even about an inflation pickup again, or a more severe growth slowdown. That, in fact, I would take that as a bullish, as a positive sign, because what it does, it really keeps sentiment and positioning in check. It really prevents sentiment and positioning from becoming too exuberant. I think if we had really everyone agreeing with each other, and then sentiment and positioning on much more bullish levels, it'd be really quite concerning because we would lack then the sort of the next marginal buyer. That, to me, would be the big risk. As long as we don't have that, as long as we have that healthy degree of disagreement in the market, that is, in fact, quite bullish because that allows days such as today.
Max, forgive me here, but your note sounded a little rock and rolly to me because you basically said every potential dip off of data, that's a buying opportunity. Sounds pretty optimistic from my point of view. What kind of data surprise would not be a buying opportunity in your view?
Yeah, look, I guess if we get, let's say, labor market data, for example, that shows very broad-based weakening. If we were to see, for example, jobless claims that are weakening in 10, 15 different states, which are driven differently than perhaps by seasonality issues, or not driven by weather-related effects, such as we've seen that pickup in claims in Texas, which was clearly related to Hurricane Beryl. If we saw a bit more of a broad-based pickup in claims, if we saw much fewer industries hiring, so if we saw in the non-farm payrolls really a sustained slump in the amount of industries that are net hiring, I think that would be concerning because it would be really clearly actually pointing to perhaps a slower and a more broad-based slowdown. Whereas what we've seen so far is it's either really related to one-offs, weather-related, or it's related to seasonality. So we can explain it away. Once we see a bit more of a severe broad-based weakening that we cannot explain away by those special factors anymore, then I would be concerned. But as I said, we don't have that at all at the moment. We're nowhere near at that point at the moment.
So Max, if the fundamentals are still in good shape, there's still reason to be optimistic then just about where we are in the cycle. What does that then tell us about positioning, and should investors still be allocating more towards the riskier assets versus getting defensive then at this point?
Yeah, absolutely. I think 100%, even at these levels, we're still in buying territory. Look, I think, let's imagine on Thursday we get retail sales 0.1%, 0.2% down. Yeah, you can get another dip, you can get a bit of a setback, but you've got to ask yourself the question, is that enough of a slowdown? Is that enough of a negative surprise that one data point is really going to challenge your constructive view? And we would clearly answer no, because when you look at the nowcasts for GDP for the third quarter, we're still tracking at 3%. No? So it is still a very, very healthy growth backdrop. And even if we had some downside surprises, fine, then you may only grow at 2 or 2.5%. but that doesn't challenge your overall constructive view. And that means you should still be adding to equities in particular, right, which should be leading the rebound here. So it really still argues for a very, very risk-on and constructive view.
All right, Max Kettner, always great to get your insight. Thanks so much for hopping on with us here this morning. Chief Multi-Asset Strategist at HSBC. Thanks so much, Max.